Value investing has gone through a transformation over the last 30 years as disruptive technologies have changed the way many companies operate. And we spent about half that time in a zero interest rate environment where high growth stocks trounced value. Now, however, in a world where we have normal interest rates again and quality matters a lot, value has seen a renaissance. However, a few big things have changed in this space. This is Brian Forster, and welcome to the Active Investor Podcast. I'm excited to have John Hardy with us today to help us navigate the current world of value investing. John is a portfolio manager here at Lord Abbett and a longtime value investor. John, great to have you on the podcast.
Thanks, Brian. Good to be here.
So this is the first time you've been on the podcast. So maybe just give us a little bit of background on kind of how you got into investing. I know you've been with Lord Abbett since 2011, been in the industry for over 20 years. How did you first get into being a value investor?
Yeah, definitely. Certainly wasn't straightforward. So I actually started, I went to school. I thought I was going to be an arbitrator for Major League Baseball. So I went to the ILR school at Cornell, realized pretty quickly that I didn't want to go to law school, and then had to sort of figure it out from there. I knew I wanted to work in finance. So I got really lucky. I got a job as a trading assistant at a small firm in Greenwich, Connecticut called American Technology Research. Really loved the traders, had a blast, but I also really fell in love with the research that our analysts were producing. We were primarily a technology research company covering things like semiconductors and software. So shortly thereafter, I went out to San Francisco to work on our semiconductor team. Mm-hmm. Semis were an excellent industry to cover sort of out of the gate as an analyst. It has a lot of obviously interesting components to it, but it's primarily a cyclical and a secular company. So you get to learn industry. So you get to learn sort of both sides. So I was on the sell side for 7 or 8 years, worked with a lot of really smart investors, hedge funds, long-only firms like Lord Abbett, private equity firms, and realized that I wanted to be, a lot closer to investing. And that's when I moved over to the investment management industry and came to work for Lord Abbett. Started to express my own views in companies.
Got it. Let's talk a little bit about the markets today. And we're seeing a little bit of volatility right now. I think AI has definitely had a big impact in a very positive way. Yep. But you're also seeing some disruptive impacts like what you're seeing in software right now. How are you just thinking about the market environment today as an active investor?
Yeah, definitely. I think over the past several weeks, people have been really concerned about industries and sectors being potentially disintermediated by AI. I think what people are sort of confused about is who are the potential beneficiaries. Right. And we think that a lot of the companies that we invest in are going to benefit. If you think about, innovation cycles over the years, most recently software or cloud adoption, that's really helped companies that we invest in on the value side increase efficiency, increase margins, increase returns. So we think there's going to be a ton of benefits for companies in our universe. In terms of top down, I wouldn't say AI is all that different from how we think about other changes in industries over time. They can be at a micro level or at a macro level, like we're seeing the impact of artificial intelligence. We really place companies into 4 buckets. The first being companies that we think are going to benefit, and the market also thinks that they're going to benefit. Those are typically, fairly valued or potentially expensive because the market thinks that they're going to benefit. The second bucket is companies that the market thinks is going to benefit from AI and we disagree with. Right. So those are obviously companies that we're not going to own at Lord Abbett. The third bucket is companies that we think are going to lose from the adoption of artificial intelligence, and the market also thinks so. So those aren't very interesting to us. So where we're spending most of our time today is on companies where the market thinks that those companies will be impacted negatively by AI, and we disagree with the market. So those are the ones that we're really digging in on, where we think there's opportunities.
Interesting. Yeah. Well, it sounds like it's a good environment for active investing then.
Absolutely.
Let's take a little bit of a walk back to the zero interest rate environment, where some might say like fundamentals mattered less. I'm not sure if that's totally true, but it does seem like since we had the big spike in interest rates and now sort of like a gradual leveling off to more normal interest rate environment, that the whole idea of quality seems to matter a lot more again. How do you guys think about that? Because I know that you talk about quality a lot.
Yeah.
I don't know that there's a lot of investors out there that say we buy garbage, right?
Right.
So
Exactly.
a lot of people have their own definition of quality, but
Yeah.
how do you sort of think about this current environment and kind of what's changed from the prior environment?
Yeah, I'm glad you used the word normal for the current environment. You know, I'm old. I remember when my first mortgage was 7 or 8%.
Right.
So it's not unusual for interest rates to be at the levels we're seeing. You know, most of the pain that we saw in 2022 was really the sharpness of moving off
Yep.
that zero bound. So I think what it's done is re-inject an actual cost of capital into the market. So again, people paid attention to fundamentals when interest rates were at zero, but the bar was much lower for companies to create economic value. So if you think about a management team that's making a capital allocation decision, whether to do M&A or buy back stock or invest in their business, if they were wrong about that decision, the penalty was much lower. With interest rates where they are today, companies have to be earning well above their cost of capital to create that buffer so that they can invest in, they can invest in their business or, give capital back to us as value investors, which we like. So what you've really seen is when interest rates are pinned at zero, the stock performance, the really simple definition of quality, whether you make money or you don't, we like companies that make money. The difference between stock performance between companies who made money and didn't make money was very low during that period. And beginning in 2021, when interest rates started to increase, you've seen that gap really widen, and that's been to the benefit of not just us, but all active investors.
Yep. So speaking of your particular approach to value investing and this whole idea of quality, it does seem like if you go back to say all the way back to Graham Dodd, but then up to the Fama-French study in the early 90s, that really said the number one thing you want to look for just from a pure metric standpoint is cheap price to book stocks.
Yep.
You fast forward to the last 30 or so years, it doesn't seem like that has worked very well anymore. How do you think about just valuation from a more holistic standpoint in this kind of new world of more innovation and kind of different types of companies?
Yeah, it's actually really intuitive. We've lived through a lot of change over the course of the last 30 years, and how that's impacted companies the most is a lot of the value that companies are driving today is driven from intangible assets, much more so than how many plants you own, and if you're a manufacturing company. Price to book doesn't really tell you anything about the return on that book. So it doesn't tell you about how much free cash flow that company is producing. I think less intuitively, because we talk so much about price to earnings in our industry, price to earnings doesn't really tell you anything about the capital associated with producing those earnings. So it doesn't tell you anything about working capital. It doesn't tell you anything about capex. So that's why we use exclusively free cash flow to underwrite the companies that we invest in. That's a real number. That's what a management team has to invest in that business. Again, do smart M&A or buy back stock, which we love.
Yep. As you kind of think about the types of companies, any examples you can give as to sort of what might fit into that kind of framework that you just described?
Yeah, absolutely. I'll give you an example of a company, Google, which we've owned for a long time. We've owned it for well over 5 years, and I often get asked by clients, is Google a value company?
Right.
But if you compare that to a company like Delta Airlines, for instance, you would assume that Delta Airlines is significantly cheaper than Google. But if you move from the income statement to the balance sheet, there's a lot of working capital associated with running an airline, whereas Google has almost none. When you think about capex, there's a lot more capex historically in a business like Delta than there is in Google. Obviously, Google's investing a lot today in their data centers to grow their AI business, but that's another example of how we would normalize that down. So even though Delta looks optically cheap on PE, the free cash flow yields are relatively similar for a much higher quality business.
Got it. So that's interesting to hear sort of Google from a value investor, but what you said makes total sense from a rationale standpoint. Do you think about other industries that kind of fit within this process, but maybe have nothing to do with AI? Maybe another example of a company that sort of fits right into kind of the way you approach things.
Yeah, I think a great example of how we look at the world, specifically around normalization, is Boeing. Boeing's obviously gone through, quite the journey.
Yes.
Over the last several years, but a lot of things have changed. So we initially purchased Boeing after they did their recent equity raise about 12 months ago. Or so. At that time, they were literally not manufacturing any planes. They obviously had significant issues with their union workforce, which were beginning to be ironed out. They were losing a significant amount of money, and a lot of cash was going out the door. I told you that I care a lot about free cash flow. That doesn't seem like a company that I would be interested in. But again, we normalize all of the companies that we underwrite. So looking out 4 years, when you're thinking about normalizing and a company's not manufacturing anything, it's pretty easy to figure out where the normalization is going to be, and that's up. Obviously, that was dependent on them, coming to an agreement with their union and begin manufacturing planes again. But we saw a path forward. Obviously, the market structure for Boeing is really strong. It's an oligopoly with Airbus. They have really strong pricing power. Historically, they've had really strong margins, high returns as a result of that. So now, fast forward that a year, they've begun producing planes again. They've recently flipped to free cash flow positive. So if you look forward over the next couple of years, they're going to de-lever their balance sheet. That's going to accrue to the equity holders, and then 2 or 3 years from now, they're going to begin buying back stock again, returning cash to shareholders. So we think the path forward in a normal environment for Boeing is going to be really strong for investors.
I'll put my compliance hat on and just say that obviously things can change, so this is not an
absolutely.
Advertisement for buying the stock, but this sort of fits your process and kind of the way you think about value investing.
Absolutely.
One thing you always often have to think about too is risk, right?
Yep.
And so how do you think about when something's not going right? And how do you think about managing risk in the portfolio?
I would say there's a couple different ways that we think about risk management. The first is upfront, before we start doing deep due diligence on a company. We look for certain characteristics in the companies that we own. The first being, attractive free cash flow valuation, which we've already talked about. The second is quality. As you said, most investors say that they like to buy high quality companies, but we're very systematic in how we think about quality. So we literally stack rank every company in our universe based on our internal quality metrics. The third thing that we care a lot about is something that we call stability. And you can really think about that as us trying to stay out of value traps. So are the fundamentals of that company stable to improving through time? There's many people that will, there's many investors that buy companies thinking that they're attractively valued today. But if those fundamentals are deteriorating 4 years from now, that price you're paying is significantly more expensive than what you think you're paying. The other thing I would say from a top-down perspective on risk management, we are always making sure that the largest risk in our portfolio is stock specific. We have an excellent analyst team on the value team. We have 14 senior analysts who are very experienced in their sectors. And given the fact that that's where we spend most of our time doing bottom-up due diligence on companies, we want to make sure that that's the biggest risk in our portfolio.
Okay, so let's kind of come back to the current environment again. And just as a value investor, no one ever likes to say, "Oh, my category doesn't have a favorable outlook for the next few years," and most want to say that it does. But I mean, if you kind of look at this environment now, it does seem like one that should be very favorable to value for the next few years, and just given the demand for quality, the demand for sort of not over leveraged companies or companies that have no earnings in sight for the next few years. But sort of like, how are you thinking about sort of the next 1 year, but also maybe the next 5 years, both for the market, but also for your style?
Yeah. There's a couple of things I would say about that. If you think about the makeup of value companies, there's Heavy exposure to financials, heavy exposure to industrial companies. We also own, technology companies, energy companies. I think one of the things that is a little bit confusing to investors is the market's at all-time highs. So people think that the economy has been booming for the last several years. But if you really look back at things like global PMIs post COVID, we've really been living through this period of what I would call middling, GDP outside of some of the things that we're seeing in technology. A lot of those excesses from COVID are finally burning off. If you think about like trucking, for instance, pricing's been very weak, and it's now the market's now starting to tighten up again. If you think about metrics like the ISM are starting to hook up, employment is still very good. So as a value investor who thinks about downside risks, that's actually a positive to me. We're not moving, from a period of, over exuberance going forward. Things have actually been relatively weak on that front. Housing is another good example of that, which has been quite weak for the past couple of years. So for all those reasons, that setup is pretty good for value. And then to your point about where there are potential risks, I do think it's important to maintain that quality bias going forward. You mentioned specifically leverage.
Yep.
Spreads are really tight today. That's not usually a very good time to be an over-levered company, because things don't get better from there. Things are already quite good for over-levered companies. So as a result of that, you want to own companies that are going to be able to invest through any tough period. But again, we look at most things on a bottom-up, company-by-company basis, and that's sort of what we get excited about.
Great. Well, a lot of great stuff there to chew on, and we'd love to have you back again sometime. There's probably a lot more to talk about. So thanks for coming.
Thanks, Brad. It was fun.
And so we'll leave it there. For investors wanting to learn more about Lord Abbett's views on the markets, please visit the Insight section of LordAbbett.com. You can also follow us on LinkedIn, Instagram, and YouTube for more perspectives from across the firm. And if you have comments on today's episode or ideas for future episodes, email podcasts@LordAbbett.com. This has been Brian Forster with the Active Investor Podcast. Thanks for listening.